In this talk we'll deal with organizational growth, and we'll start by looking at implementing growth strategies. The first type of growth strategy we'll come across in this talk is mergers and acquisitions. A merger is a legal transaction in which two or more organizations combine through an exchange of stock, but only one firm actually remains. So when I say an exchange of stock, I mean it's a legal document where the companies merge together. So one company remains and the other one merges into it. So the end of the process is one company. The start of the process, two companies or more, and they merge in and they exchange their shares so as to become a part of the single company. An acquisition is an outright purchase of an organization by another. An acquisition is when one company acquires the other. It simply buys up the other company. So a merger tends to be more voluntary. The two companies agree to come together with one company remaining, keeping its identity, and the other company losing its identity and merging into it. And it happens through the exchange of shares. The acquisition is somewhat more aggressive. One company acquires the other one. It buys it up. Now, there's also growth possible from internal development. An organization chooses to expand its operations by starting a new business from scratch. Now that would be an internal development. If a company has spare cash, if it's got reserves, it may decide to open a new business from scratch, open it from the ground up. So it invests in a new enterprise. The choice between mergers and acquisition and internal development depends on the new industry's barrier to entry. You see, deciding on whether to open a new business may be quite straightforward if the cash is available, if the company has the reserves available. But the new business may have barriers to entry. It may be highly competitive for a start, or the capital equipment may be considerable, or there may be a shortage of skilled labour in the area. There may be various impediments to opening a new business. So growing through mergers and acquisition may be a more appropriate route. It may also be the case that there is little relatedness, little linkage between the new business and the existing one. Ideally, the new business should have something in common with the existing one, so it can get support if it needs it. The support may be the provision of transport, or sharing some sort of facility, perhaps combined purchasing, so that they can negotiate better discounts. So it's a sort of economy of scale. But if the businesses are radically different, then there may be little support. The speed and development cost associated with each approach. Well, when considering growth, say from mergers, acquisition, or internal development, really the business should look at which one is best in terms of the development speed and cost. Which one is likely to yield the greatest return. So rational principles would seem to suggest that the business should work out carefully between the three possibilities. merging perhaps with a competitor, the acquisition of a related business, or internal development, using its own funds internally to set up a new business. Which one will yield the better results? There are risks associated with each approach, and these should be carefully worked out. No matter which route is taken, mergers or acquisitions or internal development, no matter which one is taken, there are risks. Risks that the businesses will not fit together well, or that there are even unanticipated costs. It could be that the product line in one of them needs updating, and the research and development department does not have the resources to dedicate to updating products or whatever. There are all sorts of risks that companies encounter when they attempt to grow. Finally, it's important to deal with the stage of the industry life cycle. Whereabouts are the companies in terms of their life cycle? Are they still experiencing market growth, or have they matured? Are they in a state of decline? And what can be done about whatever phase they're in? If they're in the growth phase, it sounds good, and it sounds like taking on an extra company and expanding is the logical thing to do. But it is going to stretch resources, it's going to stretch management, and if it's not handled appropriately, can lead to disasters, because the management are unable to cope with the additional stress. If the business is mature and not particularly growing, then investing in a new business or trying to acquire a competitor may seem like a good survival strategy, but it may also tax the business in terms of its resources. Perhaps resources which would have been better used to regenerate the original business, refresh the original business, because the management had market expertise in that area, they knew the suppliers, they know the product. So it might be better to refresh that than to launch off into a new business. The strategic partnering is another possibility, when two or more firms establish a legitimate relationship by combining their resources, combining their core competencies and their distinctive capabilities for some business purpose. So strategic partnering is when two companies agree to come together for some particular purpose. And that purpose is presumably to promote and help their existing businesses, but it may also be the acquisition of a new business or starting a new business, and they are sharing the risks and also sharing their expertise in so doing. So strategic partnering is when two companies come together for the purpose of expanding the business or supporting each other in their existing businesses. Arrangement can be used to implement any of the growth strategies. So strategic partnering can be used for acquisitions, for mergers, or for an entirely new business. And once the parties to the agreement sign up to it, then they collaborate to try and make the best out of the decision they've made. It could be vertical integration. Vertical integration is when a company moves closer to the customer. That's vertical forward integration, I should say. Vertical backward integration is when the company moves back in its supply chain and tries to acquire suppliers so as to have the security of supply. So it could be the company moves towards the customer, vertical forward, or it could be moving back towards the supply end, which is vertically backwards. Or it could be horizontal integration, when simply two companies come together for some strategic purpose, and then they decide to acquire another company who's in the market producing something related to both of them. That's a horizontal integration, where they are taking on a third company and integrating that third company into their businesses. So they've come together. It's also possible that strategic partnering may happen between a company and a company that deals with this product closer to the customer. That's vertical integration. So in this case, it's not two companies going for a third company. It could be two companies, one of whom is further along the supply chain towards the customer, which is vertically forward, and the two companies agree to share resources and to share information and to collaborate. Or it could be the two companies are at the same stage in the supply chain. They are actually competitors, and they simply get together and agree to share information, share resources, and work together. So it's the end of competition in that sense. It could be related diversification. So they could diversify by taking on a different company, or there could be two already different companies that are forming the strategic partnering. So what they're doing is they're diversifying, and in that way hoping to reduce risk. If one part of the business experiences problems, the other part may save it, may do quite well. So it could be something to do with diversification, diversifying what they're doing so as to reduce risk. Now, implementing growth strategies. Well, the types of strategic partnerships, well, it could be a joint venture. That's two or more separate organizations when they form an independent organization for strategic purposes. So two or more separate organizations form an independent organization. Sometimes it happens when companies are going to set up overseas in a different country. They look for a company in that country who have got local knowledge and who can bring to bear wider knowledge of the market and also the conditions for business in that country. And they set up a joint venture, to set up an agreement to start a company between them to look at the possibilities of importing and exporting and manufacturing overseas. So it's a joint venture. Generally speaking, partners own equal shares in the new venture. Generally speaking, they tend to share it equally. And it's used when the partners don't want to be legally joined. The two companies don't want to be legally joined, but they set up a third company and they can share the third company. But they want to keep their existing companies. They want to stay separate. So they have their separate organizations and they set up a third one in which they agree to share. Long-term contract, well, it's a legal contract between organizations covering specific business purposes. So it may be that companies simply draw up contracts for them to deliver certain products or to share information or to share responsibility for certain aspects of their businesses, and the contracts specify the terms and conditions under which they will operate. This typically happens between an organization and its suppliers. The contract may specify that the suppliers will deliver certain amounts in certain time periods, and in return the organization will pay perhaps a small premium or whatever. It depends on the terms of the contract and what they negotiate. Types of strategic partnership continued. Well, strategic alliance is one that's often mentioned. This is when two or more firms share resources, share capabilities or competencies to pursue some business purpose. They share resources. They share their skills and their competencies. It's strategic alliance. It's similar to joint ventures, but there is no formation of a separate entity. There's no new company formed. They simply have two companies and they agree that they should share certain information, share perhaps transport, share capabilities, share knowledge with each other, perhaps have joint training programs for their staff or whatever it is. But it's not a new company. It's not like a joint venture which will set up a new company. The two companies set up a new one for a joint venture. In this one, they stay independent, but they agree to share certain functions. As a consequence, the partners, of course, benefit from expanded operations. So in this session, we've looked at ways in which companies can grow. Mergers, acquisitions, establishing a new business between them, then strategic partnering and strategic alliances and joint ventures. Now all of these terms and these concepts are important, particularly in the study of strategy, business strategy. So it's important that you understand each of them. So it's wise to rewind, go across it again, make notes, and look at other classes that are available in this area. Plus, do some reading, make your own notes, and be sure that you understand what a strategic alliance is and a joint venture, and be able to distinguish them. Talk about acquisitions and mergers and what they are and their advantages and disadvantages and so on. But that's all I'm going to deal with in this session, so I'm going to leave it at that and say thank you for watching.